Hi, everyone. We apologize for that short delay. We're having some technical issues on our end, but we are so excited to present you with the March market update. We have poured our heart and soul into digging through all of the current changes in the market. It has been absolutely wild, and I'm sure we can all attest to that, but we are here to try to make some sense of it. We are open for questions, so be sure to use the question box. And on that note, I would like to thank Jerry for saying he saw a dog. I have never known that you could preview my shared screen. And so you got a glimpse of my dog, which is my background, his Christmas card photo. So that is my pup. And thank you for letting me know. So I'm not Google searching, does this hot sauce give me heartburn before you all are on. But thank you so much. And for those of you that are joining us from Lifestyles Unlimited, I just want to thank you guys for coming up to us at the expo over the 17th weekend of March. We were so surprised by how many of you love the webinars and frequently watch them, always save the recordings. It was really amazing because it lets us know that what we're doing makes a difference, and it's not only helpful to you, but it's something that you look forward to. So we are so glad that you joined us for lunch. Oh, Jiminy Crickets. I hear an echo. Did someone mute? Awesome. Okay, I think we're back. So again, we're just having a little bit of technical issues today. So if you'll hang in there, we have some amazing content for you, and we are so excited to get started. As always, we will be doing a half off your hard money processing fee for those that are joining us live. So make sure you stay on through the end, and we'll be announcing our winner at that time. Additionally, this broadcast is being recorded, and you will receive a copy of this in your email the following day. And if you guys have any questions for our experts that are on the call today, be sure to use that questions box. We will be answering those at the end of the call. If it is something very specific, we will probably pass you on to one of our fully licensed loan officers so that they can help talk to you directly about a specific deal you're working on. But if it's a question we think everyone can benefit from, we're happy to ask and answer online. Before we get started too, we just want to go over our disclaimer. This information that we share with you, we hope helps you. We really want to encourage you to keep an eye on the market and everything that's going on. But we do want to let you know before you go into a deal, you are liable for your own decision making, and it is important to do your own due diligence before going into a deal. All of us and our speakers, our guest speakers, are not liable for any decisions you make hereafter. I would also like to introduce you to our two speakers. If you are coming from Real Estate IQ and you know Steve, but you don't know us, let me introduce us. I'm Destiny Fernandez, the marketing manager, and we have our founder and CEO, Wade Comeaux here, who started his career in 1995. He is also an active investor himself, so the information that he'll be sharing with you today is not only coming from over 20 years of experience in the lending space, but also that same amount of experience coming from personal experience. One thing that we really strive to do in our company is help people avoid mistakes in their own deals because we've made them so that you have a more fluid and seamless transaction. We also have our Director of Lending, Jeff Johnson, on the line. Welcome. Jeff has also been in the industry for over 20 years. He started, actually, I think that Jeff and we updated his bio yesterday, but Jeff, when did you start? Tell me, was it 19? Jeff, are you there?
I'm sorry, I was muted. So I got in the business in the late 90s, so 1997, I think that's to be exact.
I'm having trouble hearing you, but that's okay. We know Jeff has over 20 years of experience, and if you were to work with us, he oversees all of our deals, and you may even interact with him directly if you're deciding to work with us in the future. Jeff strives to provide excellent customer service and a streamlined transaction. Next, I'd like to introduce you to our guest speaker today, Steve Liang. We're so excited to have you back. Thank you for joining us.
Thanks for having me.
Absolutely. So Steve is a spiritual capitalist. He's also a national speaker, and he's the founder and CEO of Real Estate IQ, which is an amazing company. And I know I wouldn't do justice explaining what you do. So I'm going to pass the mic over to you and let you tell us a little bit about what it is your company provides for all the investors out there.
Thank you, Destiny, and really glad to have the opportunity to be here. Thanks for joining us today. So Real Estate IQ is a data company, and we focus on finding deals for real estate investment purposes. So the past, about 6 months or so since the foreclosure moratorium has lifted, we're seeing a pretty big insurge of distressed properties that are, these are motivated motivated sellers who are not selling the properties on the market yet, but we have a way to mine information and locate these investors. So we've been in business for almost 10 years now, and we've been helping a lot of investors acquire deals and also reach their retirement goals. So really glad to be here.
Excellent. I just want to say that Steve and his team do a great job. Many of our borrowers use their services and have found outstanding deals, and it creates real deal flow for them.
Thank you.
Awesome. Thanks, Steve.
All right. Talk a little bit about Catalyst, who we are, and our value proposition. We're a one-stop shop for all your hard money and permanent financing needs. We are, as Destiny mentioned, real estate lenders built by real estate investors. So we do try to pass on the experiences we've had and help you guys succeed and increase your returns. We really focus on a single point of contact model, which allows you to have one person for all the different real estate investment products that you would need, from short-term financing to long-term financing. You're going to have that one person that's a trusted advisor to help sure you make it through that process smoothly and easily. We do have 5-star average customer service reviews on all social media platforms, and we offer more specifically these particular products: hard money, which is the money to purchase and repair distressed real estate; conventional loans, which are the best priced products, government subsidized, and can really get you the lowest rates possible. Then we have non-conventional loans, which are more flexible. We offer 30-year no income doc loans, so you don't have to provide any income documentation in order to be a long-term buy and hold investor. We also offer primary refinance, purchase, and cash out. We have a lot of our customers now getting cash out of their homes, still take advantage of historically low rates to fuel their real estate investments. And if you're mulling that over at all, please reach out to us now, because we are in a rising rate environment, and I do not see it coming down for quite some time. We also have a great VIP flip program that really gives you some flexibility on your draws. Very attractive interest rate is as low as 9.99, maybe even lower for elite borrowers. And we really like to work with elite flippers who have a lot of experience. We can provide great services for them. We also have these non-QM products with rates starting in the low 5s. Those are the non-qualified loans that we talked about earlier. And we also have Airbnb loans, both on the conforming and the non-conforming side. So this is a super hot area. The average income on the short-term rentals is 61% greater than the long-term rentals. So it's an exciting area to be in. If you want to get into that space, definitely talk to one of our loan officers after the call today.
Awesome. Thank you. All right, we're jumping in. Who's ready?
Okay. Can you guys hear me?
We
Yes.
can. All right.
All right, good deal. I don't know what happened there. Sorry about that. So we covered this chart, and just to kind of piggyback off what Wade was saying earlier, just real quick on the Airbnb stuff. That is, I think that's going to be the biggest growth segment we see on our side. We're a lot of customers are really looking into that because the cash flows are so great relative to single family. Their properties are a little more expensive a lot of times. You may have to spend a little money to get them ready and furnished, but the cash flows are much higher on most of these deals. I don't know, Steve, if you guys dabble in that at all, or if you have any customers that you talk to that do Airbnbs.
Yeah, we do. Airbnb has been, so there are a couple of things. It's getting more and more popular. A lot of our clients, I've been noticing that they, and some of the market leaders too, they have kind of switched their business model to managing Airbnbs also. So you can be a landlord and somebody else is operating the property for you. We actually have one that are slowly turning into a profit now. And we chose to do that instead of doing a long-term rental because it's just kind of a prime area where people want to stay in. So it depends on where you have your property at, and if it's being managed well, I think there's a pretty good cash flow that can get generated for you. The other point I wanted to make was the trend of a lot of these new property acquisitions. We're seeing an uptick in trends where these home sales are bought by investors. So that also contributes to the fact that we're seeing a lot of Airbnb loans, and I haven't seen any other lenders that offer Airbnb loans either. So when I attend your event, this is the first time I hear about this amazing product. So really excited that you guys are offering that.
Thanks, Steve. It is. We think it's really going to help a lot of people get into that exciting space, acquire homes in those more touristic areas that are more expensive, but that can really have great returns and great appreciation opportunity as well. There's only so many touristic areas with mountains, water, etc. So it could be a great chance to get in on it.
Right.
Yeah. Okay. So, can you go back, Destiny? We didn't really talk about that. Or David, whomever. Thank you. We always include this chart as a frame of reference for a big reason as to why we are seeing such high appreciation in the market right now. This is the list of housing starts over the last, I guess, what is that, 60 years or so? So from 1960 on, number of properties that have been, or number of homes that have been built over the decades. And as you can tell, starting in 2010 to 2020, over the last 10 years or so, this is the lowest 10-year decade period that they've seen since this chart. I don't know if there's before or not, but at least since the 1960s at a minimum, this is the fewest number of homes being built over the last 10 years. So you couple that with the population growth and the millennials hitting home buying age, you can see why we are having such inventory problems, and it's one of the reasons why we're having such inventory problems, and so we're having such high price appreciation, like historically high price appreciation. And this is kind of like the framework or the foundation as to why these problems are occurring. Problems or opportunities, I guess, depending on your side of the transaction. But this is a large reason as to why we are where we are.
Absolutely. So home sales nationally did drop a little bit more than expected in February. That does not mean that home prices dropped. There were just fewer sales, and that's an inventory issue, not really a desire issue. I think there's still a lot of demand, just not as much supply. Median home price nationally did increase 15% from a year ago, so that's still a very strong number. There are more homes that came on the market in February compared to January, but there were just 870,000 homes for sale at the end of the month, so a 15.5% year-over-year drop. So that inventory that was kind of pent up, that did not happen at the beginning of the pandemic, has been depleting regularly, and there's just not that much on the market, right? And I think that's why we're seeing that price pressure, people feeling the need to, make very aggressive offers, and until that starts to change, we're going to still continue to see a lot of rising prices. There are some things that are impacting that. Of course, mortgage rates increasing has a direct impact to purchasing power, right? So if you can afford a certain home at 3% and you're not going to be able to afford the same home at 4%, so you have a tighter group of potential buyers, and everybody is going to offer, no matter what price range they were at before, they're probably going to offer less unless they're just willing to press on and they can afford it, or for some other reason. But on average, people are going to pull down a little bit in the price range whenever rates do increase. And the comment from Lawrence Young, the chief economist with Realtors.com, said it will be very interesting to observe what's going to happen in the coming months as mortgage rates make much more of a meaningful jump. Now, I was just at a convention in Miami. Interest rates have increased tremendously over the last couple of weeks. I see no indication from anyone that that is going to change anytime soon, including the Fed saying directly that they plan on raising interest rates at least a quarter at the next 7 meetings, which does not have a direct correlation to mortgage interest rates, but it's definitely an impact. And it would not be surprising to see a comparable increase in that same time frame. So in other words, we could be 1.75 to 2% higher at the end of this year in mortgage rates. So it is an excellent time to lock in at what is still historically low rates. And that honestly will be at the end of the year. We have another chart, even at the end of the year, if we're up 2%, those are still historically low interest rates. What are you seeing out
talking
there?
about
What are you
rates.
hearing, Steve, on rates? Sorry, Jeff.
That's okay.
Yeah. Yeah, I was gonna comment on the same thing. We're still looking at very historically extremely low interest rates, even at 4%, 5%, and the money is still very cheap to leverage on right now.
For sure.
Yeah, that's good perspective. I don't know if the chart's in here or not, but we typically include it that show the historical ranges from, I think, from the 70s on. And while it's not as low as it's ever been, if you look at just where we're at relative to the last 50 years, we're still definitely well below the average for that time frame. So it's,
We do have that chart.
People get, it's easy. What's that?
We do have that chart, so we can cover that in a little bit. For sure.
It's easy to get spoiled, I guess. Next. So I thought this was an interesting topic as somebody who was in the business back in the financial crisis meltdown back in 07, 08. But the housing bubble is brewing, but not like 08. First of all, just look at that chart. It shows U.S. home price growth. And if you look on the left-hand side, starting in roughly 2000, I guess, all the way to 2006, it was a pretty long time. It was, that's a good 5+ years of significant appreciation. But look at the chart on the right. Obviously, it's a much smaller time frame, but look how much higher that number is relative to what was seen as like an obscenely positive time in values, right? Values were going up tremendously. And there's a lot of differences between that and now, but that was considered the good old days, the 2000 to 2006 run up. And if you look at it now, it's significantly higher. So the article hits on a couple things. It says year over year, U.S. home price growth accelerated 19% in January, which is up 11%, up from 11% last year. So it's almost an 8% jump. The latest jump is also well above the peak annual rate of 14.5 posted in the lead up to the 2008 housing bubble. So this is the interesting part, why they think we are not headed towards a 2008 bubble crash. Households are in much better shape today versus they were in 2007. In 2007, 7% of U.S. disposable income was going towards the mortgage payments. At the last stats last year, it was below 4%. So that is significantly better. And then this other one down here, it's cut off for some reason. But in 2006, rates jumped up quickly, not unlike what might happen now, but the higher rates were coupled with ARMs. So that ultimately sped up the demise of countless subprime mortgages and set the stage for the 2008 crisis. These days, about 99% of all mortgages have fixed rates, so higher mortgage rates will have little impact on current homeowners. So back then you had these issues, but you also had rates going up, and it was affecting current homeowners. So they were in worse financial shape to begin with. They were at a much higher debt ratio. You had lower qualified borrowers getting properties. Back then, literally, you could just give a mortgage to just about anybody, as opposed to now, where the credit quality is really, really high, especially when compared to that. And you had all these ARMs that were taking people that were already in their mortgages and significantly increasing their payments. So when you factor all that in, it's a recipe for disaster. We are not in that situation right now. There aren't many people that have ARMs. The credit quality of the borrowers are much higher, and they've typically got more assets. Their balance sheets are better now than they were back then. So when you couple all that, I don't think it's going to be nearly as bad as what we're talking about in 08, 09, and 2010.
Actually, this article, the title is surprising to me because it really doesn't talk about a bubble happening. It doesn't say it projects any decreases in prices. So the topic or the title is a little bit odd. But I agree with Jeff. There are several other reasons, even in addition to what they say here, that I really don't believe it's going to be a comparable situation. FICO scores are significantly higher than they were at that time. It was not just that people were on ARMs, they were also on what are called interest-only loans on their owner-occupied properties. So they were at super low teaser rates. They often had interest-only loans, the lowest possible payments, and people were just buying homes that they knew they would not have the ability to pay because they thought they were going to be able to sell them at a later point whenever the homes would appreciate. And whenever that music stopped, it was a real problem. All of those hybrid products, there are very few, if anything, like that in the market today. So it's very different. Credit profile's better, lower percentage going towards mortgage payments. And then the other huge thing is that at that time, there are a lot of people who could not make their payments and they were put on forbearance plans, right? Those forbearance plans were required to be paid in full at the end of the forbearance. So if you couldn't make a payment in 18 months, how in the world were you going to be able to pay it in 1 month, right? Like that just doesn't make sense. And the federal government has already committed that they will allow people in this particular circumstance, if they need to go on a forbearance, and there aren't nearly as many, they will allow them to add it on to the end of the term, which is a massively different thing and a very good decision to keep some type of, extreme foreclosure situation from happening. So I think the consensus we saw in a lot of the opinions at this event, which was a mortgage industry event, and also what I read is that there will be a deceleration, which I truly believe. I don't think we can maintain this pace for the foreseeable future, but I do think I don't personally see a reduction in values. And actually, this article, despite the title, did not say that either. Any other thoughts on that, Steve?
Yeah, I would agree. I think we're seeing the housing prices has been rising too quickly. I think since January of 2021, there's a huge increase in home prices in the entire country in general, and in some of the more popular counties, we're seeing like 25-30% in just 1 year, and that's we don't want that to be sustainable, obviously. And I think the Fed is taking steps to kind of control that. But I don't really see a drop in prices either. They're just trying to decelerate that price increase because right now it's kind of going out of control. We're not going to be seeing 25-30% home price increases, and I think even between even for the year 2021, I think we're going to see a much smaller pricing growth.
Yeah, the article was interesting. It's basically the only thing that it said that I thought was interesting was he said that housing prices appear increasingly out of step with fundamentals. So when somebody says that they're out of step with fundamentals, that's the part that gets my attention. It's like, well, so what do you mean? What is out of step? And so talked about rates being low and all the millennials hitting home buying age, and that's normal. That's to be expected. He said the one thing that he pointed to that was not in the fundamentals was a fear of missing out, like the mentality that people were buying houses because they didn't want to get left behind. So I think that's the part that he's saying is a little bit out of step with just kind of basic economics. But yeah, I don't see it going down anytime soon. I think it's just going to slow down the increase significantly.
An interesting trend I want to share that I came across lately is that a lot of first-time home buyers are experiencing buyer's remorse because of this whole frenzy of trying to get a house, right? The fear of missing out. Maybe they have skipped some inspection reports, or they just kind of overlook some of the items in order to get the house. And now they're sitting on a problem they don't know how to fix, and they are going, well, is really, having a home right now, is it a really good time? Is it a really good decision? We're seeing a lot of regret there, so it could also turn into an opportunity for investors as well.
I did not know that. That's good info.
Interesting. All right, this next slide from Fortune discusses how middle-class households have made more than $2 trillion from homeownership over the past decade. And, you know, in inflationary environments, owning primary residences or investment properties, you know, any hard assets like real estate are great places to have your money, right? Because if you have it in cash, even though you might not lose anything technically, you're losing purchasing power, right? And last month, year over year, I think inflation was 7.9. It's been steadily in that range. So while you might have $100,000 in the bank, that $100,000 is cannot purchase as much as it did the previous year, right? So that's a big difference. But in most of these inflationary periods, home prices have outrun that number. So I know everybody's like, man, you know, 15% home appreciation is unreasonable in the long run. But if you think about it, if we have 8% appreciation, then that's only 7% true appreciation, right? And it's not that different from the long-term historical trends. So I think it's hard to expect it to decrease as long as inflation is high. That's going to be that would be very, very surprising to me, because people know the purchasing power is just different and that they're trying to put their money into hard assets. But the rest of this article has some interesting things. In the past 10 years, they've been able to enjoy massive gains. As we said, there's in only 1,000 U.S. cities, there's over 8 trillion since 2010. NAR estimates that 86% of the wealth homeowners built during this period comes from appreciation. So you always hear the statement made by Peter Kiyosaki and other people like that say, you know, homeownership or owning real estate is the best way to add wealth, right? And this is a great example, right? So if you look at it, 86% came from homeownership, which is a pretty powerful number. And then you look at what's that?
That's a huge number. I mean, if you think about it, that's how most people that's how most people gain net worth over that. That's a huge number.
Yes. And then there are a couple metro areas that saw the biggest gains. And I think we did a report last month where Phoenix had like the top year-over-year growth. I want to say it was like 12 consecutive months or something like that. It was really crazy.
It was way longer than that. It was something ridiculous. Yeah.
Yeah. Very impressive. That market is super hot. Of course, Austin right in there, Nashville, Tennessee, Dallas, and then Houston. Houston's also on the chart with some of the biggest wealth gains. So very exciting numbers there across the board. And areas that it sounds like these are all areas, if you listen to the trends from like the moving companies and just the census data, these are all states where people are migrating to these states in mass numbers. So that's another reason why I think these particular areas, including Texas, the state that we're in, are very stable, because whenever you have people moving in and a strong job environment, that's a recipe for success.
Yeah, I want to add maybe another data point here is that there's some recent census data that shows the population growth, and the top 10 metro area. Number one is Dallas-Fort Worth, so it aligns really well with the top 5 here. The second one is Phoenix. The third is Houston. Number 4 is Austin. And so we are seeing, you know, these are the top 4, and number 5 is Riverside, so kind of the OC area.
So what are those? Those are the top 5 markets where people have moved into?
Yes, sir. Yeah, net growth.
Interesting.
Gotcha.
And then it's followed by Atlanta, you know, Tampa. So we're seeing Georgia and Florida. Those are kind of big states. Number 8 is San Antonio area, which is also Texas.
Man.
Then we see North Carolina and South Carolina. That rounds out the top 10.
So all 10 are in the South.
Correct.
And 4 of the 10 are in Texas.
Yeah.
Okay.
Pretty good indication of the future for sure.
Correct.
Next
All
slide.
right. So Wade was right. So this is the chart that we were discussing. And as you can see, obviously you got the little uptick, but that's pretty sharp. I'm not gonna lie, that's a sharp uptick. However, if you look at overall, yeah, we're still, there's maybe a handful of months that are below this, relatively speaking. So, you know, and people were buying real estate in the 80s. I promise. I know maybe you may think that nobody was doing deals back then, but they were. And especially when you consider the fact that rents have gone up so much over the last couple of years. You know, you have these rates go up and your payments go up a little bit, and I understand that. But rates and interest payments relative to the rents is still a no-brainer. Like the rents have outpaced the rates by a large margin over the last couple of years.
Yep. And
Next slide.
I did have one other thing to make a comment on here. I know people may think that there's still maybe a probability that rates are going to start to come down, so they may be holding off on decisions to buy. I don't believe that is a wise move. That's my opinion. But with what the Fed has straight up said they plan to do, and they were very reluctant to say that for better part of a year, saying inflation was transitory, and so they're very reluctant to do that. Now that they're committed to the plan, I don't know that they're going to waver from it unless things really start to improve in the inflation front. But if you look at this time when rates are at 18%, what's the other common thing? That is when inflation was through the roof, right? And so the way that the Fed turned that around was a gentleman named Volcker increased interest rates up to 18% very quickly, right? And actually, I heard Jerome Powell say something positive about Paul Volcker the other day. Like he said, he is dedicated to a comparable plan. Now, one other thing to keep in mind, not to the extreme, to a comparable plan. He is willing to increase rates, so that's something. But the thing that's different, if you look at the amount of national debt in the 80s versus where it is today as a percentage of GDP, we were at about 30% of the GDP in debt. Right now, we're at like 125% of our national. So we're like a person who spends more in debt than they earn every year, which means you're kind of running up the credit cards. Scary place to be. But the only thing that makes me feel more comfortable about rates not going as high as this is we have to pay out all that debt to other people at the interest rates which we set, right? So there's going to be this turmoil between slowing down inflation and potentially incurring massive amounts of debt or paying out massive amounts of debt, bills to our bondholders. And that is going to be where I don't see it going that high, but I do see it having to go up in order to combat inflation. So probably not 18%, but I do not see it staying as low as it can today if we're going to be at 8, 9, and 10% on inflation, which is currently projected by many prognosticators, right? I don't know if you have any thoughts on that, Steve.
Nope, no. When around 2020, I think when we start seeing the stimulus money getting released, the bills being signed and everything, where we were already kind of talking internally about how is that going to do with the interest rate? You know, inflation is going to start coming, and then the next thing is going to be the interest rate, and we just don't know how crazy that's going to be in controlling this inflation. I think it's kind of a wait and see a type of thing. But I agree with you too, Wade. You know, I think it will be, you know, at 18, you know, double digits. It's a little harder to fathom right now.
It is. I don't think we're in a position to do that with so much debt like we did last time. So I agree with you. That number is really hard to visualize, stroking that big of a check to the bondholders every month. That would be damaging to the budget for the U.S. for sure.
Right.
All right, next slide. All right, Houston. So Houston had a lot of strong categories. Destiny did say, Jeff, that something on this chart in particular really impressed you. I don't know if you remember what that happened to be, but I will go through it.
The only thing it impressed me for a second, and then I realized why. So the total number of sales I thought was, up 25%. That's crazy. But then as I was reading through the article, it reminded me of what was happening in February 2021, was the freeze. And so the growth in the units is artificially more impressive than it really should be. However, it made a point to say back to 2020, February 2020, the last normal February, it was still significantly higher than what happened back then. So the year-over-year comparison is a little skewed because of the freeze. But
Gotcha.
that was it. Yeah.
That makes sense. A couple other things that we see that are very common across the US and especially in Texas: listings down, sales up. Like that's not what you always see. But what happens and how that is possible is super low months of inventory, right? 1.5 last year, 1.3 this year, so still down in months of inventory. Average prices up significantly, sales price up 13.4%, median sales price up 19.3%, and pending sales are up significantly as well. So it looks like, you know, pending sales is often a leading indicator on eventual sales, but still extremely solid there. Days on market fell from 48 to 41. That's a really big jump. Now I do agree with Jeff. There were some weird things going on in February of last year with the freeze, so that may have a lot to do with that. And then we've been tracking, you know, the rents pre-COVID were at 1768, and then now they're at 2052. So in that time frame,
Wow.
$250. That's big. And the thing is, that does not sound as big whenever you're comparing to 1768. But the number you should be comparing to is where you cash flowing $300 or $400 before that. So it might be potentially just a massive increase over where you were before, right? That you might be 50% increase to your previous cash flow. Maybe it's 75% increase to your previous cash flow. The other factor to keep in mind that we're all feeling a little bit is taxes, right? The taxes have gone up on our properties. So that is one thing that you definitely want to do, is always do it yourself or use someone else, but do appeal those taxes. You can often get some positive results there. But outside of the taxes, it's a pretty exciting jump. Anything in your opinion that you've seen, and Steve, you want that you want to talk about before we move on to San Antonio?
Yeah, we can move on.
Okay.
Next. All right, so San Antonio. The percentage of, so the total units, right, total sales, last year was 2681. I'm sorry, last year was 2450. This year was 2681. So a 9% jump, not nearly the jump that Houston saw. The average price went up from 311 to 361, which is a 16% increase. Median price is up to 314. Days on market, like Wade said earlier, you're starting to see a lot more just acceleration, and deals aren't lasting. It's kind of the same old we've been talking about. Days on market are all the way down to 38, which is a 27% drop. That's pretty significant. And then the rentals, I do look at the rentals. For whatever reason, San Antonio rents just aren't keeping up with Houston's. Although their prices are not that much lower. I think the median price in Houston was like 328 and San Antonio is 314. So like the prices are pretty similar, but they aren't able to collect those rents in San Antonio for whatever reason. The average rent is, what is that, 1755 compared to Houston, which was I think 2000. So it's $300 less per month in San Antonio. What's that?
2052 was the Houston number.
Yeah, so it's right at $300 less, and I'm not quite sure if there's any, if Steve, if you know anything about San Antonio and why they can't rent as high as they can in Houston, but it's still a really good market. Like you said, it's number 8 in growth. So I anticipate this to keep on going up, just like it would in all the other Texas markets.
That's a good question, Jeff. Whenever we get to the affordability index page shortly, it looks like the average household income is very comparable for both places. So it is interesting that Houston can get so much more rent. It's a little bit hard to put your finger on, but it's been a long-term trend.
Yeah, it's been lagging, and I'm not quite sure why.
All right, next slide, please. Dallas. Do you live up in Dallas, Steve?
Yeah, I live in Dallas.
So. Man, maybe
yeah,
you ought to
I can take this one. we're seeing a big. I was thinking about that too. We're seeing a big increase, almost 20% in median price increase. And this market share number is actually very interesting too, when it says 26.7%, because this is kind of the percentage or the price range where we see a lot of first-time home buyers, purchasing on. And so that's at about a little bit over a quarter. Active listing has come down, and I find the days on market very interesting too. So I think across Texas we're seeing about 30, 40 days on average on days on market, and I think that's the overall. When we're seeing different hot pockets within the Metroplex area in our kind of local publications, some of the days on market is like, man, less than 10 days. If it's a really hot area, I'm sure you guys are seeing that in the popular area in Houston, San Antonio, Austin too. And so I think this number, depending on the desirability of the area, can be quite different than what the average number shows here.
And I do think it's important to note that this is a North Texas, not just Dallas.
Right.
So it kind of takes in a larger area, some smaller tertiary markets. And I think because of that, it's even more impressive that Dallas's numbers are second only to Austin, right?
Right. You're right.
Because if we were including a wider swath of areas outside of Houston or San Antonio, the numbers would not be as strong. And Dallas still 1.1 months of inventory. I mean, that's huge. 18.8% year over year. That's huge. Like those numbers are very, very impressive considering these smaller markets are included.
Yep.
All right, next slide. I'll take this one. Austin, median sales price up to 500K, 27% year over year, really big increase. That is down a little bit from the 30% that they were over last month. It's an interesting thing whenever you see 27% increase and you're like, oh, that's slowing down a little bit, but I guess that is the case. Days on market or months of inventory, just incredible, right? 0.4. That's
first time I've seen it go up in that I can remember. Like it's been flat forever. I guess it was 0.3 before, but tough times. It's up to 0.4.
Yeah, complete slowdown there in Austin, just 0.4 days.
It's just like it's a meltdown.
Pending sales still really high, active listings still really down. That's why you have that such a low number there. Total sales volume still up 34%. That's a very exciting number. Days on market down 4 days to 28. So some indications of things going quicker. The inventory number is a little counter to the days on market, but overall just an amazing market. And at this particular event, it was very interesting. Austin Poole was with me, and the number of people from other parts of the country who were like, man, I want to move to Texas, or I am moving to Texas, or it was really shocking how often we heard that at this event. Everybody from many of the larger other cities in the US that we're going to cover in this affordability index in a moment. Like I didn't hear one person that did not indicate that they either wanted to or were jealous of the experience that we're having here in Texas. So it's pretty amazing. So anyway, to go into this next slide, I'll let Jeff take this one, but I'll make a comment or two on the affordability index.
Sure. So this is a measure of just how affordable it is to live in a certain city. It takes into account your income or the income of the city, the average income of the city, and then the estimated mortgage payment, which will accounts for taxes and whatnot. So, basically, if you look on that percentage of income for payment column, it's like, okay, if you were to live here, how much of your income, if you're the average citizen, how much of your income would go towards your mortgage payment? And so you can see up at the top, cities like Miami, New York, LA, Newark, and Jersey City. Those are the top 5 most expensive or least affordable places. And then you start seeing, I didn't put every city on here, but I put the Texas ones. You got Austin, Dallas, and Houston. So one thing I noticed as I was looking at this just now, so we were talking about the disparity between Houston and San Antonio. I'm not sure where they're getting the data from. I'm gonna look it up next time we do this, but The home price disparity on this report, if you look at San Antonio, number 51, is 266. Houston's 334. So those are very different than what the numbers we just reported from the respective markets are. So I'm going to take a look at how this affordability index is calculated, because the incomes are the same. And you would think if the home prices were the same, San Antonio and Houston would be right there neck and neck. So I'm not quite sure where they're getting that San Antonio number from. It seems way lower than what Sabre was reporting. But as you can tell,
Jeff, it may be that they're doing something. They're grabbing a number not unlike what Dallas reports, where it's a broader area. That often happens. They're pulling in some of the further out suburbs or near suburbs. Then maybe that's dragging that number down. Could be a thought.
Yeah, and I expect a little bit of play in the numbers, but that's pretty significant. So I'll have to look at that as far as why San Antonio is so different than what we have. But Dallas is about the same. Houston, Austin, those are all pretty consistent with what we have. But yeah, start like you were saying earlier, a lot of these big cities like Austin, or if you're in Dallas, if you're trying to buy rental properties, it may not work. But a lot of times you can move out to the smaller cities or tertiary markets, and they're starting to really move out into those spaces to find good deals.
Yeah, Jeff, I think, from this chart, I was just very impressed by all the Texas cities. I mean, we're not in the top 20 in terms of unaffordability. I guess the higher the number it is, the more unaffordable it is. And some of these home price numbers is just average. I think, if we're talking about a nicer neighborhood in those cities, it can be even more unaffordable. That's why you're seeing so many renters in the area living in the suburbs traveling into the city to work.
Yeah. And it doesn't, in speaking with these gentlemen, and I've mentioned this in the past, there are a lot of other factors in here too, right? State income taxes are incredibly high in some of these places. That's not baked in here, taking up even more money. Taxes on gas. Like if you look at the average gas price in these cities, significantly higher than it is here, 50% more in many of those states as well. So a lot of other factors coming in there. So that's just why I think people are going to be able to come here and afford to pay more for homes significantly for the foreseeable future, because they have more dry powder with which to do it, right? They have more money. And if they're coming from that place and they're selling at these high prices, they'll also have a lot of money for down payments. So I think there's a lot of positive things, even if things happen in the market nationally on a macro level, that are going to not impact our area as much because of these factors.
Yeah, Wade, I see. I've been talking to a lot of folks as the world starts opening up, and a lot of folks are transplants from New York, the largest cities. They're much happier, and get this, first of all, they're much happier with the affordability, the quality of life that we can afford here in Texas. And number two is they can still work remotely. I have met couples who live in Miami, and they are still working in New York, so they're getting New York salary to afford the much cheaper cost of living in other cities. And some of them, when they first moved here, they would stay in an apartment for a year or two first to check out the area. And I think they are still talking about the dry powder weight. They're still sitting on the sideline, and they could potentially also continue to fuel the housing boom here especially in Texas.
That's absolutely.
It's funny. When we were looking at this, when we were putting this together, I saw an article. We didn't include it, but it had a list of, I think, the top 10 markets people were moving from, and then it listed their in-state destinations and out-of-state destinations, like who's going where. It was really interesting. So a lot of cities in California, most of them were either moving to Washington or Arizona, which makes sense in Arizona. And then the ones on the East Coast, there was New York, they were moving to Miami. Was the majority of it, right? So it was pretty interesting to see where people go from. They're definitely coming from the coast, and it's just a matter of where they're going.
Awesome.
I do think that.
Guys.
Yep. I was just going to say that ongoing trend of some people being able to work remotely in tech spaces and stuff. I think that's really going to continue to drive that. Yep.
That was the part I left out. That was the point of the article, was that people were able to work remotely, so they're moving out of these places where it's so expensive to live and just go and find a much higher quality of life, much cheaper.
Sure.
All right, Destiny, sorry, go ahead.
That's okay. I have two neighbors that work remote and they work in different states. So they're on different, like two of them are on mountain time. So they're just kind of funny to see that shift and that transition. And I wonder if that's also what pulled Miami up, because as we've been going through these market updates and having the affordability index, if you've tuned in for a while, this is the second or third month only that Miami's been number one. It had been New York, fairly consistent. It had been New York, New York, New York. And then we had this shift. I think it was last month or the month before. And so I wonder if that has to do with all of those new transplants moving in. And one more note, I just wanted to add this. Steve mentioned people coming to Texas and enjoying, you know, all the different parts of our culture, but we're also nicknamed the friendly state. If anyone didn't know that, we're the friendly state. So for those of you that are joining from out of state, people come, and I always say they come and they plant their roots because everybody's a little nicer around here. So especially if you're coming from, you know, like New York, and then you come down here and everybody says howdy to you. Awesome. Well, we have quite a few questions. We're coming up on time in about 3 minutes. We'll be hitting 1 o'clock. So we are going to try to answer those. But if anybody was interested in reaching out to Steve, you can find his contact information here on the screen. We'll also include it with our follow-up email where we provide you a copy of this presentation. And without further ado, I will jump into some questions. So again, yes, we are sending a copy of the presentation. So the first question, and then this one, a few of these were asked during the presentation while we were on specific slides. So I may flip back to reference if our speakers aren't sure what the question is asking. Just let me know, guys. The first question is the downturn in sales really just market supply number as opposed to being a function of interest rates? So I think they're asking, is it supply or is it the increase of interest rates?
It's, in my opinion, the majority of it is the lack of supply. The rates are, they will eventually, they're going to start creeping in and phasing out certain buyers because they just can't afford it. That difference in rate will equate a difference in payment, and it'll push them out. But everything I've read and believe is that it's way more of a supply problem. The rates going up are not good, but it's not the main reason why we're having these shortage issues, these price issues.
Yeah, and when Jeff and I were doing research, we came across this article that was saying how sales between 100 to 250K have dropped significantly, and we were kind of chuckling. We're like, well, because there aren't any. So of course the sales are going down. There's not any to buy in that price point.
Correct.
And on the flip, the increase was 750 above, and it's because that's what you can find on the market. Wade, I think you had a point. I apologize for interrupting.
No worries at all. The only other thing I was going to say is that there are times whenever people are pushed out of the market, but that's usually with more extreme rate increases. Sometimes they just step down a little bit, right? They just step down to the market. So before, when rates were 3, maybe they were able to afford a $300,000 house, and now maybe they're only able to afford a $225,000 at current rates. But many of them are still going to buy, right? They're still going to buy. Now, there are people who are looking for an upgrade in their home and now they can't do it. That's more the people that may be challenged. But if they're moving, which is happening to a lot of our buyers in the state are movers, right? It's still way cheaper than where they were before. Prices are still historically, interest rates are still historically low. So I don't know if that is going to be impacted very much. It will mostly be people that were like, oh, interest rates are low and I want to level up on my house. I do think that will slow down.
Yeah, and we're only seeing one small uptick on the interest rate so far. And I think as the year continues, as the year progresses, and we're seeing how quickly and how much these interest rates are being tweaked up, I think we'll can also kind of see a better trend of what's happening too. You know, I think as it adds up, I think it's going to have a bigger and bigger impact.
Absolutely. So our next question is in the same mindset, but from someone else and has a slightly different take on it. Does this have anything to do with the price of building materials going up so high?
Sure.
That's it, Jeff? That's your answer?
Color commentary by Jeff Johnson.
Yes. Yes. Next question. No. Yes. In my opinion, it does. Everything I've read is that it's still very expensive to build a house. Like the cost of materials has gone up. I even read something that said that there were materials in Ukraine that were essential to building homes that were going to, the war there was going to affect home prices because of the war. I'm not sure what it was, but yes, I was hoping that with the pandemic seeming to wane and slow down, that things are going to open back up and prices were going to be a little cheaper. But that is not the case. From everything I've read, it's still more expensive to build a house than it was pre-pandemic, and it's not changing anytime soon. I don't know if you guys have anything different, but that's everything I've read.
We'll quote you at the end, sure. We'll be like, join our webinar. We have amazing speakers. Jeff Johnson, sure. Thank you, Jeff. This question is great. And actually, I think this one could be one for you, Jeff, as well. This is someone asking, what is an ARM?
An adjustable rate mortgage. So you have a rate you start with, and that lasts for a fixed period of time, maybe 2, 3, 5, maybe even 10. But they have a fixed rate. It's a certain rate and certain payment for a fixed amount of time. And then at some point, that rate adjusts. And if rates go up, your rate could adjust significantly, where your payments goes up significantly. So that is an adjustable rate mortgage.
Awesome. And that goes back to the housing bubble slide, which our next question is also in reference to. So they have mentioned, NAR said this might look similar, but it isn't a recipe for another housing bubble. So I think those kind of go into play, and that's more of a comment, but it's a second voice on what Wade had mentioned earlier. And that goes back to, now that you have a better understanding of what ARMs are, how that all incorporates. And I don't know if anybody wanted to elaborate or add anything else to that point before moving on.
Yeah, I think just one last thing to emphasize is that there was a double whammy of both adjustable rate mortgages and the interest rates adjusting in large numbers, and then people often borrowing at 125% of the value of their homes, right? And then home prices started dropping. So you had a confluence of so many factors going on at that time that really it's hard to foresee many of them taking place at this time. You would have to have so many things go wrong that are not trending in that direction at the moment that it would really be surprising to see something that strong.
Yeah, and I think the housing bubble of the past decade just hit us. You know, that was the source of the previous economic downturn. I think it will take a couple more generations. This is my bold prediction. You know, just very philosophical, more so than hard facts.
Roll tape.
Is it'll take a couple more generations, I think, for us to forget, and then it may happen again.
Sure. I think there will be those alternative products at some point in the future again. People get complacent, right? We're not even close to those products. I mean, Jeff and I were lending some of those products, and it is much tighter today. And the diversity of products is not anything like it was back then.
Yeah, the lending world is not forgotten. Not even close just yet.
Awesome, thanks guys. I also had 2 questions on this, and maybe the screen cuts off the way I'm sharing it, I'm not sure. But they were asking the horizontal timeline on the 30-year mortgage interest rate graph. What is that timeline? Is it 100 years?
We can
No.
Give me 1 second. I think it's like I started in the 70s, I believe. I think it was in the 70s.
Okay.
1971.
1971.
Yep.
Okay, awesome.
1971
Thank you.
to 2020.
And if anybody did see that it was cut off, let me know so I can try to fix that for the next webinar. Thank you guys for bringing that up, and maybe it was just that it's too small to see as well. But we'll be sure to make a note for next month so everyone's aware, because we did get 2 questions on that. Okay, this is our last question. And it's a long one. So I think I'm gonna break it up into two parts because it seems to be an A and B. So bear with me. What or how is it best to purchase hard to fix purchases if it takes a month to build, if interest rates keep going up for the hard to fix final loan? That's the first part of the question.
Can you repeat it?
Yes.
I
What
didn't
or
quite understand
how? What or how is it best to purchase hard to fix, so I think fix and flip loan purchases if it takes a month to build, if interest rates keep going up for the hard to fix final loan? So I think they're asking like if they were going to work on a distressed property, if interest rates rise in that first month. And if you want, I'll read the second part of the question because maybe it'll grab some clarity. The second part of the question is, B, possible rates going to drop appraisal values of the house and prevent you being stuck with the house not appraising for loan or loans going up too much too fast. Thank you. So I think we could talk about a bridge loan here.
Yeah, so
But I think they're trying to find out what happens if interest rates rise while they're in the middle of fixing before they get to the long term. And if I'm wrong, please let me know.
that sounds right. If someone is doing a buy and hold loan and they're going to be using a conforming refi, we have an excellent product that does not require you to have new comparables pulled within the first 4 months. So that's a very exciting product that will give you some comfort there, I think. If you're flipping the property, definitely interest rates adjusting has an impact, right? People's purchasing power goes down. The good news is if you're flipping in reasonable price points, we often target in a 500-ish area. Some people are up to $1 million. If you don't get into the really big price points, there's always someone who's coming down into your price point as interest rates increase. So I still think that there's going to be some appreciation that often usually takes place in that time frame, right? While you're in the current market, home prices are appreciating 12%. Then, if there's a 4-month repair, that's 4% appreciation as well. I would not depend on that, but that often happens. But it's something you always want to be cautious about. If you're a newer investor, understanding that there are significant holding costs and that the market could change, those are always important things to think about. And we really encourage our borrowers to always have an exit strategy that is converting into a long-term loan in case something were to happen, because real estate almost always bounces back. So if you can hold it, rent it for a while, make money on it until the market bounces back, you normally will not get hurt, right? So that's why it's one of the great things that our loan officers are able to do is to let you have a two-pronged exit strategy with one credit pull instead of only saying my only option is to flip. If you know the other option, it can be helpful in making a decision.
Awesome, thank you. And they did confirm that was their question. And they said,
Perfect.
thank you. Wow, you're so active. We appreciate that. And without further ado, drum roll. Our winner for the half off your hard money processing fee is Sarah Henderson. Congratulations. You'll be getting an email from me, and we'll be connecting with a fully licensed loan officer if you have not already been in touch with one. Steve, thank you so much for joining us. We love having you on here. We always get such good feedback when you join us.
Absolutely.
Yeah, thanks, Steve.
Appreciate that.
Thanks a lot, Steve. And if you guys have not checked out Real Estate IQ, be sure to do it. He has a great team. They can make a big impact in your ability to find off-market deals, get into some really good both flip and buy and hold property. So definitely check them out.
And we have a tech team in place, so we're actually actively involving our clients to build out the next generation product. We'd love to get in touch with you guys and learn from you how we should continue to build out our product.
Awesome.
Excellent.
All right, guys. Well, thank you so much for joining us. We will see you next month.
Cheers.
Adios, everybody.
Thanks.
Bye-bye.
Thanks, everybody. Thanks, Steve.
Thanks for having me.
All right, bye-bye.